Imagine you bought a house in 2021. You did everything right. You saved for years, you got pre-approved, you put 20% down, you locked in a 30-year fixed rate at 2.9%. Your mortgage payment was manageable. Your neighbors thought you were lucky. Your parents said you were smart. And you were, at the time. Now it is 2026. Your house is worth roughly what you paid for it, maybe a little more, maybe a little less, depending on what city you live in. But here is the thing nobody told you. You are not going anywhere. Not because you love the house, not because the schools are great or the commute is perfect. You are staying because you literally cannot afford to leave. That is the trap, and tens of millions of Americans are sitting inside it right now, pretending it is a home. This is the mortgage crisis nobody wants to admit is happening. Not the banks, not the realtors, not the politicians who spent 3 years telling you the housing market was just cooling off. It is not a crisis of foreclosures and defaults, not yet. It is something quieter and stranger, and in some ways more dangerous. It is a crisis of paralysis, of a housing market that has, for all practical purposes, stopped working. And the longer it stays broken, the worse the math gets for everyone involved. Let us start at the beginning, because this story did not start in 2021. It started about 20 years earlier, in the wreckage of the last housing collapse. After 2008, the Federal Reserve did something it had never done at that scale before. It cut interest rates to nearly zero and kept them there for years. The logic was simple. Cheap money encourages borrowing, borrowing drives spending, spending revives the economy, and it worked. Sort of. The economy recovered, the stock market soared, and somewhere in the background, almost unnoticed at first, home prices started climbing. They climbed through 2012, through 2015, through 2018, each year a little higher, and each year the explanation was the same. Low rates make mortgages affordable, affordable mortgages create demand, demand pushes prices up. Supply was not keeping pace. Zoning laws made it hard to build. Builders were still skittish after 2008, and so the gap between what houses cost and what people earned slowly, quietly widened. Then 2020 happened. The pandemic arrived, and the Fed, facing an economic catastrophe, did the only thing it knew how to do. It cut interest rates again, this time to essentially zero, and flooded the financial system with money. Mortgage rates fell to historic lows. 30-year fixed rates dipped below 3% for the first time in recorded American history. And Americans, many of whom were suddenly working from home and reassessing everything, decided it was time to buy. What followed was not a housing boom. It was a housing detonation. Prices in some markets went up 30, 40, 50% in less than 2 years. Houses in Phoenix, in Boise, in Nashville, in the suburbs of every major city. People were waiving inspections, paying $50,000 over asking in cash, bidding against investors with algorithms. And the real estate industry, which runs on transaction volume, cheered every single step of the way. By the time 2022 arrived, the median home price in the United States had hit an all-time high of over $450,000. The average rate on a 30-year mortgage was still around 4%, painful but survivable for many buyers. And then the Fed blinked. Inflation, which had been building for over a year, in which the Fed had famously called transitory, turned out to be very much not transitory. The Fed panicked. It raised interest rates 11 times in roughly 18 months, the most aggressive tightening cycle since the 1980s. By the fall of 2023, the 30-year mortgage rate had crossed 8%, the highest it had been in over 2 decades. Now do the math with me, because this is where things get genuinely uncomfortable. In 2021, a buyer purchasing a $400,000 home with 20% down had a monthly payment of about $1,330. Taxes and insurance on top of that, sure, but the principal and interest alone, $1,300 a month. That same house today, if it has held its value, and many have,
costs $400,000. But at current rates, hovering around 7% as of mid-2026, that monthly payment is now approximately $2,120. Same house, same loan amount, $800 more every single month, nearly $10,000 more every single year, just because the rate changed. And that is if the prices had stayed flat. In most markets, they did not. So here is the crisis hiding in plain sight. Anyone who bought between 2020 and 2022, and there were millions of them, is now sitting on a mortgage rate between 2 and 4%, a rate that under current conditions they could never get again. If they sell their house and try to buy a comparable one, their monthly payment essentially doubles. This is what economists call the lock-in effect. It sounds polite and academic. What it actually means is that a massive portion of the American housing supply has been taken off the market indefinitely by the people who live in it, not because they want to stay, but because leaving would be financially devastating. The numbers are striking. According to estimates from housing researchers, roughly 60 to 65% of all outstanding mortgages in the United States carry a rate below 4%. Many of those homeowners have equity. Many of them are in houses that no longer fit their lives, too small for a growing family, too large for empty nesters, in the wrong city for a new job, in the wrong school district for kids that have now grown up and left. Under normal market conditions, they would sell, they would move, they would add inventory to a market that is desperately short of it. But they are not moving, they're staying put, because the math says they have to. And here is where the irony deepens into something almost absurd. The very tool the Fed used to fight inflation, higher interest rates, is the same tool that broke the housing market. The Fed raised rates to cool demand, and it did cool demand. Home sales collapsed to their lowest level in nearly 30 years. But it did not cool prices, because supply collapsed too. Sellers stayed put. Inventory dried up. And so you ended up with the worst of both worlds, a market where almost no one is buying and almost no one is selling, and yet prices remain stubbornly elevated because there is simply nothing to buy. A functioning market requires both supply and demand. What we have right now is neither. What we have is a standoff.
Now you might be thinking, okay, this is uncomfortable, but people adjust. Buyers wait. Sellers eventually have to move. Life happens. Divorces, deaths, job transfers, financial distress. The market will eventually loosen up, right? Partially, but here is what makes this cycle different from anything that came before it, and why the people who should be sounding alarms are mostly staying quiet. The gap between where rates are and where they would need to be for the market to normalize is historically large, not a little large. Historically large. During most periods of rate dislocation in the past, the spread between prevailing mortgage rates and the rates locked in by existing homeowners was maybe 1 or 2%. You might hesitate to move, but the penalty was manageable. Right now, for someone with a 3% rate looking at a 7% rate, the spread is 4 full percentage points. On a $400,000 loan, that is not a rounding error. That is a life decision. That is the difference between a payment you can afford and one that stretches you to the absolute edge. And the people who bought most aggressively during the pandemic frenzy, who paid the highest prices, who stretched the most, are also the ones with the most to lose by moving. They are pinned, not just by rates, but by the prices they paid, by the equity they have not yet fully built, by the terrifying arithmetic of what comes next if they try to unlock themselves from where they are. So the market is stuck, and the consequences of that stuckness are spreading. Consider what a frozen housing market actually does to the broader economy. Housing, directly and indirectly, accounts for somewhere around 15 to 18% of U.S. GDP. That includes construction, real estate services, mortgage lending, home improvement, furniture, appliances, the entire ecosystem of things that get bought and sold when people move. When the housing market slows to a crawl, that spending slows with it. Furniture stores feel it. Moving companies feel it. Mortgage brokers feel it.
New home builders feel it, though they have actually been doing relatively better than existing home sellers because they can offer rate buydowns and incentives that individual sellers cannot. But the ripple effects go further than that. Think about what happens to labor mobility when people cannot afford to move. A tech worker in Austin with a 3% mortgage gets a dream job offer in Seattle. Under normal conditions, she moves. Under these conditions, she either turns down the job, negotiates to work remotely, or does a complicated calculation about whether the salary bump covers the mortgage penalty of relocation. Sometimes it does, often it does not. Multiply that decision by millions of workers across the economy, and you get a labor market that is subtly, quietly less dynamic than it appears on the surface. Think about what happens to household formation. Young couples who cannot afford to buy are staying in rentals longer. Renters who cannot find affordable rentals are staying with family longer. The average age of first-time home buyers has been creeping upward for years. It recently hit an all-time high of 38, not because people don't want to own homes, because the math of ownership has become so punishing for anyone without a large existing asset base that the American dream of homeownership is quietly being rationed by net worth.
And then there is the political dimension, which is where things get genuinely complicated. Housing affordability is now consistently ranked among the top concerns of American voters across party lines. Politicians know this, which is why every election cycle produces a fresh round of proposals: subsidies for first-time buyers, restrictions on investor purchases, zoning reform, tax credits, down payment assistance programs. Some of these ideas have merit. Most of them are either too small to matter at scale or too politically difficult to implement at the speed the problem demands. What none of them address is the core mathematical reality. You cannot make housing affordable with either meaningfully lowering prices, meaningfully lowering rates, or meaningfully increasing supply, and all three of those outcomes have powerful constituencies working against them. Existing homeowners, who are also voters, do not want their home values to fall. The financial sector has a structural interest in rates that generate margin, and the coalition of local governments, neighborhood associations, and incumbent landowners that opposes new housing construction has been blocking density for 50 years and shows no sign of stopping. So when a politician says they are going to fix housing affordability, it's worth asking exactly which of these three levers they are actually willing to pull, because the easy answer is none of them. Let us talk about the scenario most people are not saying out loud. What happens if rates stay elevated for longer than anyone expects? Not 8% elevated, but 5, 5.5%, 6% elevated, which is roughly where they are sitting as of mid-2026. That is not a catastrophe in historical terms. In 1990, you would have celebrated a 6% mortgage. But in a market where prices are still near their all-time highs, a 6% rate on a $450,000 home still produces a monthly payment that is simply out of reach for the median American household. The median household income in the United States is approximately $80,000 a year, which translates to roughly $6,600 a month before taxes. Financial convention says you should not spend more than 28% of your gross income on housing. That gives you about $1,850 a month for a mortgage. At 6% on a conventional 30-year loan, $1,850 buys you a loan of about $310,000. The median home price is about $400,000. That gap between what a median household can responsibly borrow and what a median home actually costs is not a small rounding error. It's nearly $100,000, and it's not closing. It's been widening steadily for the better part of a decade. There's a phrase economists use for this kind of situation: structural misalignment. It means the gap is not a temporary blip that corrects itself naturally. It means the market has drifted so far from the fundamentals that it requires either a significant correction or a significant policy intervention to find its way back to normal. The 2008 crisis was, in its brutal way, a correction,
prices fell sharply. It was painful. It wiped out trillions in household wealth. It caused enormous human suffering. But it did reset the market to something closer to functional. Prices came down until people could afford them again. The crisis we are in now is different because it is not collapsing in that dramatic, visible way. There is no wave of foreclosures. Delinquency rates, while ticking up slightly, are not flashing red. The job market, though softening, has not produced the mass unemployment that typically triggers a housing crash. Homeowners who locked in low rates are not in distress. They are just stuck. Which means there is no acute pain forcing a correction, just the slow, grinding pressure of a market that has priced out an entire generation and called it stability. There's one more piece of this puzzle that does not get nearly enough attention: the investors. During the 2020 to 2022 buying frenzy, institutional investors, large corporations that buy single-family homes and rent them out, accelerated their purchases dramatically. Companies like Invitation Homes and American Homes for Rent were buying tens of thousands of properties. Private equity firms were acquiring mobile home parks and apartment complexes. Individual investors with capital were snapping up starter homes in Sunbelt markets faster than first-time buyers could compete. Now, the data on exactly how large this institutional footprint is has been debated. The industry insists it is a small fraction of the overall market, 5 or 10% in any given area. Critics argue the concentration in specific price tiers, specifically the entry-level homes that first-time buyers need, makes the impact far larger than the aggregate numbers suggest. But here's what's not debated. Those institutional investors also locked in financing during the low-rate era. They are also sitting on properties they paid elevated prices for, and they are also making the rational calculation that selling into a slow market with high rates is not in their interest right now. So the institutions are stuck too, holding, waiting, and renting out properties that would otherwise be available for purchase to people who can't afford to buy anyway at current prices, in a cycle that has its own grim internal logic. The renters pay, the institutions hold, the first-time buyers wait, the existing homeowners stay put. Nobody moves, and the market churns in place, producing enormous friction and very little actual housing mobility for the people who need it most.
Here's what the optimists will tell you, and they are not entirely wrong. They will say that rates will eventually come down. The Fed has signaled that its tightening cycle is over and that cuts are coming, though the pace and depth of those cuts have been revised downward multiple times. When rates fall, some of the locked-in homeowners will start to move. The spread between their existing rate and the new rate will narrow. Transactions will increase. Inventory will loosen. The market will begin to breathe again. This is plausible. It may even be likely over some multi-year horizon. But the optimists tend to gloss over the timing problem. Even if rates fall to 5.5%, which would be a significant decline from today's levels, a homeowner at 3% is still looking at a 2.5-point spread. On a large loan, that is still hundreds of dollars a month. Hundreds of dollars a month is still a real obstacle for real families making real decisions about whether to list their home. And lower rates will also reignite demand from buyers who have been sitting on the sidelines. More buyers chasing still limited inventory does not necessarily produce a more affordable market. It might just produce another round of price escalation, which is what happened in early 2023 and early 2024, whenever the market caught wind of potential rate relief and buyers flooded back in before supply could respond. There is no clean path out of this. Every exit has costs and trade-offs and political landmines. The people who designed this situation, and to be clear, no single person designed it, it emerged from decades of decisions by regulators, legislators, central bankers, developers, lenders, and buyers, are mostly not the ones who will pay the price for it. The ones paying the price are younger, mostly.
They are renters paying 40% of their income to live in cities they can barely afford. They are couples delaying children because they cannot find a house large enough to start a family. They are workers who cannot take better jobs because the cost of relocating would wipe out the salary gain. They are people in their late 30s watching the asset-building window that previous generations walked through close, quietly, without anyone making an official announcement. So where does this leave us? The honest answer is, in a place that defies easy resolution. The crisis nobody wants to admit is not a prediction. It is not a warning about something that might happen. It is a description of something that is happening right now in slow motion, in the gap between what housing costs and what most Americans can actually afford. It is playing out in rental prices, in delayed life milestones, in labor market rigidity, in a growing sense, felt especially among people under 45, that the rules of the game have fundamentally changed in ways that nobody is being straight with them about. The banks are not going to call it a crisis. Their loan books are mostly fine. The realtors are not going to call it a crisis. Their commissions depend on optimism. The politicians are not going to call it a crisis unless they have a plan to solve it, and nobody has a plan to solve it. The homeowners sitting on 2 and 3% rates are not going to call it a crisis, because for them, personally, it is not.
It is only a crisis if you're trying to get in, or trying to get out, or trying to navigate an economy built around a housing market that has, for all practical purposes, stopped functioning as a market. The question worth sitting with is a simple one. We spent 15 years pumping cheap money into an asset class that millions of people need simply to have a stable place to live. We inflated prices beyond what wages could sustain. We locked in a generation of buyers at those inflated prices with ultra-low rates that can never be recaptured. And then we raised rates to fight the inflation we helped create. Who exactly was this system designed to serve? Because it is increasingly clear that it was not designed with the median American household in mind. And until that question gets asked loudly and honestly in congressional hearings and central bank press conferences and real estate industry conventions and dinner table conversations, the crisis will keep being exactly what it has been, something everyone can see and nobody wants to say out loud. A trap shaped like a house.